Well, lots to chat about. So let's bring on board Sunil Subramaniam, MD and CEO at Sundaram Mutual, who's with us in our studios. Good morning and great to have you on board, Sunil. Let's wanted to just start off by talking about the once hefty premiums that some of those mid caps commanded over large caps. I think that's a thing of the past now, and a number of corporate governance issues really seem to have spooked investors. Do you think that that story is now long gone, or is it likely to return?
I think that the concern over corporate governance is a new factor for the market, and I think it will have time to play out. I don't think we've seen the end of this yet, partly because I think the promoter holding being pledged and being used to finance investment in other things is a very widespread phenomenon.
Yeah.
And you only had 2 or 3 which have come out, right? So in a following market, if their share values are getting corrected and they have borrowed a lot, and people are associating this with corporate governance, which I think is technically not correct, you know. So I think that if you see shareholding related issues, pledges will feature now and then, and I think the important thing is to keep in mind the actual corporate governance in terms of whether they are being ethical in their management and fair in their business practices.
Right. Sunil, done with most triggers, both the interim budget, the policy, all done with at the fag end of earnings. From now up until elections, where will the market be drawing its cues from?
I think now until the elections, it will be essentially news flow around the tie-ups of the various parties, political news flows, and second is various opinion polls and exit polls.
So elections essentially.
Elections will absolutely dominate the scene because you see, if you see the government's infrastructure program will probably be on hold for the next few months. So order books or anything are not going to be in the news. The second is that on the consumption front, while the government is releasing this money, it will take time to reflect in the numbers in the following quarter. So technically speaking, and even from abroad, the news flow at this point in time, I think that with the US is uncertain on whether there is strong growth or not. While the Fed is dovish, the unemployment rates are quite strong. So I don't think Brexit is one small issue which would come up. Italy is another issue. So there will be odd news flows, but I think elections will dominate that stuff, and hence I think domestic fund managers will be sitting on the sidelines by and large in the next 2 months, while FIS will take a call based on longer term outlook. So I would say the market will have a sideways movement till the elections. Nobody is willing to make a strong commitment.
Yeah.
But, since we're talking about global factors as well, the Economic Times is saying that Paul Krugman as well is seeing a possible US recession. How worried are you about that scenario really playing out?
We think it's closer to a slowdown as opposed to a recession, right? And if you see what many people are relying on the spread between the 2-year and the 10-year, you know, that negative turn of that has been indicative of recessions in the past. But I think that the past that they've seen, you got to take out the Volcker era, take out all those extreme steps. What we feel is that the Fed is being cautious, right? And the second thing is that, but the footprint at the ground level is pretty strong. So I think that a recession is in our frame of mind quite far away, but definitely a slowdown is on the cards. So I think that's where we are in reality. I think it's too strong expectation of a recession in the US.
Okay, fair enough. So one shouldn't really be worried by that. Now, you continue to reiterate your positive stance on the consumption space. You even said that with, some of the reforms in the election, that this space is likely to continue to see a recovery. What is the long-term stance? Do you like a particular pocket within consumption?
I think the low end of consumer durable discretionary.
Okay.
So you have the high end of high-end cars and high-end thing, but the refrigerators, air conditioners at the low end of, because if you see a lot of this money which is being released is of small amounts of incremental, and rather than go, while FMCG will get a pickup, the fact is that people use that to take slightly higher EMIs to slightly upgrade that car, upgrade that AC, right? So we see the low end of consumer discretionary durable as the one which is going to really see a pickup, and in the back of it, all these products need financing. So we believe consumer financing on the back of it will support this.
But this is the part of the market which is lagging, right? Because across the segment, we've seen auto numbers, dispatch numbers as well as earnings. They're hard hit. Just yesterday, you had Eicher, Motherson Sumi both downgrade their outlook. We've seen Maruti grappling, the largest market leader, shareholder, that also grappling with its own issues. And that can be said across segments. So where is it that you find value? Where do you think when the cycle recovers, they're going to recover fastest?
Okay, so three things that I want to respond to you. First is when I think about consumption, it's about the demand and the top line growth as opposed to the margins and the EPS growth, because those are company specific, those are crude oil, dollar specifics, right? So I'm talking about strong consumption revival at the top line level. Second aspect is that there will be price pressures, right? So when you say top line growth of say 10 to 12%, prices are going to be 1 or 2%. So we think of what 14% earnings. And the third thing you mentioned, an interesting point, where do you see value? No, we don't see value anywhere. This is not a value play, right? This is high growth, which is being high expectation. So where the expectations will play out is still not value. So if you ask me from a perspective of growth versus value, this is actually the growth play. And because there is visibility to the growth, it's actually the safety play. Please read my words carefully, right? Normally, value is perceived as safety because the valuations are low. But no, we see that the higher valuations because...
So pick a name within autos.
No, I can't pick stocks.
Okay. No, what I meant was whether passenger vehicles, whether...
Two-wheelers. Like I said, low-end consumer discretionary, two-wheelers fits in brilliantly.
Bajaj is, motor cops. Okay. Move forward and just want to talk about, where exactly we are when it comes to the steel cycles. To what extent would you say is the global situation cushioning Indian steel prices, given that the steel industry, just stock price wise, has almost halved from its 2018 peaks? Again, is there value on the table there?
There is definitely value on the table. It depends on the tenor of your outlook. So in a 12 to 18 month, I would say there is no value because the international recession not from US but from Europe and the slowdown in China indicates softer steel prices. So in a 12 to 18 month, but on a slightly longer, if you extend your tenor to 36 to 64 months, we believe that the Indian capex cycle, lots of industries are going past the 80% capacity utilization mark. So we are seeing that the conversations we are having with companies are talking about the fact that they are looking at doing capex once the election uncertainty is over. So when they then start placing the order book for a 2022 capacity finally coming into play, steel is one of the key things which you demand. So we believe demand for steel will pick up. So if you have a 3 to 5 year outlook, there's fantastic value in steel. But you have to be clear that in the mid term, there will be volatility and there will be pain on the floor. So if you're willing to ride that volatility phase and your portfolio clearly has a 3+ year outlook, I would say steel is a good sector to buy.
What about, the overall export-linked themes with the way the currency has been moving? Is that a space that you would look at?
We think that this year actually currency is going to be relatively stronger as opposed to weaker because the dollar is going to be weaker, crude is going to be supported to India. So we believe that exports from a currency push is not going to happen. Okay. Where second is the recession in the Europe, right, backed by the slowdown in the US means that export demand itself is going to be softer, right? One. The only silver lining here, again from a time frame perspective, is that any tensions between the US and China, if India gets their act in order and gets the right, we could substitute a portion of the Chinese supply to the US. But it's a longer term play, you need policies into place, you need a lot of stuff to happen. So again, if you have a very medium term outlook, I would say it's a play, but not 12 to 18 months, we actually see a stable rupee. And though it's not necessarily straight away export positive.
Right. We were just taking note of what SBI Mutual Fund has done in the month of January. So tell us, what are your biggest overweights and underweights and any portfolio rejigs that you may have made in the month of January?
Okay, so the biggest overweight for us are on three things. One is on auto. We are very outlier in that auto space. We have another fund also which is very strong overweight on auto. The second overweight we are on capital goods. Part of the reasoning for that is 60 to 70% of funds that we have are mid and small cap funds, and they are all stocks bought with a 4 to 5 year outlook. With that, on a capex cycle, cap goods, industrials, building materials, we are heavily overweight. Where we are very underweight is on pharma. consistently over the last 12 to 18 months. Despite all that's happened with rupee weakening, everything, we have stuck to our stance. We are heavily underweight pharma. But that being said, within pharma, healthcare and diagnostics are somewhere we are not that underweight. We are okay. Where have we changed in recent months? It started a little earlier than January, is in corporate banks. So the huge shift in our portfolio is in terms of corporate banks, where we were heavily underweight earlier, and we are moving into neutral, and over the next few months you will see us being overweight on the corporate banks. So that's the biggest portfolio shift, so to speak.
You're increasing exposure to corporate banks.
Yes, absolutely, increasing exposure. And overall, as a play, services as a play. Whether it's financial services, anything, even like diagnostic, everything comes under services. We are very bullish on the services play.
Now, despite the uncertainty that you spoke of that could play out due to elections, you continue to maintain that stance of 11,500 to 12,000 for your targets for the index?
Yes, because we believe that 17 to 19% growth of earnings in the large cap space is not unexpected, and about 23 to 24 on the mid caps and 25 to 28 on the small caps. So if you look at it, the valuation, so if you take Nifty itself, the key is that we believe that the sectors which will drive the Nifty may be very different from what drove them last year. But there will be such a strong bounce back in the banks and in specific sectors that I think 11,500 to 12,000, this is not a very big number, right? It's what, 10% growth in the thing. But I think it's a reasonable expectation. We stick to that stance on a financial year end perspective.
Wanted to just discuss, the entire prospect of telecom, and we've seen as to how Bharti's performance has been, how an idea is not really aggressive with its capex. Just in today's newspaper itself, Economic Times, you have Kumar Mangalam Birla's interview as well. Do you believe that all our eggs are in one basket, and that's Reliance Jio? Or is it a complete avoid telecom for now?
It's a complete avoid. Because while the initial winner seems to be that number, we still think that there's lots of uncertainty at play. So we said that from a stock market perspective, I buy a movie ticket and watch the fun happening and not actually go dig my fingers into this.
Sure.
Okay. There was some commentary that came out from DLF as well in their analyst meet. They're seeing, growth in their overall rentals, the ramp up in the pre-sales. What is the story for real estate according to you? Does that fit into the same basket as telecom or even pharma, where you're saying it's a complete avoid, or you think that there is some potential over there?
There is some potential, but we are still not comfortable. Okay. But I would not put it in the same basket as telecom. We think a lot of the budgetary announcements were supportive of real estate. We think valuations have corrected, and so we believe that there is good news in the story, but still we are not yet as a fund house ready to make a commitment there. But I would say that we are still underweight, we are still staying away, but I would not say we will stay away for as long a time as we will from telecom. So we are observing and closely watching that sector.
You said that you like capital goods as a story, and in January you've increased exposure as well to cap goods. What gives you this conviction? And again, where within capital goods do you find value? Because that's also a very large umbrella that we're talking about.
So basically one thing is that when we speak to a lot of companies in the quarterly results space, we see that a lot of companies are saying that they are going past their 80% capacity utilization levels. So there are two kinds of companies here. One which needs to do small debottlenecking to increase capacity. They are very bullish about doing that. So we call this the short cycle capex, right? That in lots of companies are going to start. Second is that there are other companies where they already full up, they've done their debottlenecking, but they're saying that for 2022 they see that they are short. So they are saying they will, post the election uncertainty, start placing orders, right? Now a capex cycle story is a order book story as opposed to actual earnings coming through, right? So the market always reads ahead. So we believe that a lot of them say that we will commit in April. A lot of them say we'll wait after the election. But when that starts, it's the EPC contractors, it's the building materials, it's the cement, it's the steel, it's what goes into the factory shed has to come up, right? So those are the ones that we believe will, so short cycle capex plus EPC contract, building materials, those are the ones which will initially the order books will start reflecting, and the valuations, which all have corrected big time over the last 12 to 18 months, will start picking up. And we believe this is a good time to buy. But clearly that's the portfolio, part of the portfolio, which is with a 3 to 5 year outlook. So we are taking the bets there with the extent of wherever we have space vis-a-vis the benchmark, we are filling in with that.
Okay, and a last word, what is exactly is the view on the oil and gas space?
Neutral.
Okay.
We believe that with an election, the oil price pass on. See, inflation is low, so government shouldn't have a problem with letting the pass through happen. So refining margins should be intact. But the uncertainty is with a new direction coming, new government coming in, right? Whether they will stick to this government's policy of passing it on or be more populist in their view. So we believe a neutral view at this point is more...
Would be safest. Okay, Sunil, great to have you on the show. Thanks so much for taking the time out.